I'm going to speak to the entire think tank of Credit Suisse next week from their Asia Investor Conference, which happens in Hong Kong. But before that, I've got Nilkant to talk to me with regards to the markets and what to expect from the conference as well. So, Nilkant, thank you very much for joining us. We'll talk about the conference and the markets as well. But first, on this big telecom merger, it's been going on for a while now. It's official that Idea is going to merge with Vodafone. Does it change the merit of changing your view of the sector, or you think one is to be still cautious?
No, I think the game has just started, right? So for the longest time, the industry was in an equilibrium where Bharti was happy being number one, Vodafone was happy being number two, Idea was happy being number three. I don't know if they were happy about it, but at least they weren't doing anything about it. Now we have three claimants to try to be, the leader, and there will be a clear jostling of space. One of the companies has already claimed that they want to settle at 50% market share. So the real fun is still ahead of us. And while it may be exciting for the economy as a whole that we get very cheap telecom services and we see a complete disruption in how our infrastructure shapes up, I think for the companies involved in this battle, it will be a very bruising one. So we stay cautious.
But the fact that the number of players in India are going to go down, that the data consumption is going up, you've also mentioned in your report tracking Reliance as well, that the data consumption has really gone up tenfold for the sector. Given that, you think the pricing power will eventually come for Idea Vodafone merger combined and for Reliance and for Bharti to survive this big data growth which we are seeing right now?
See, right now the market shares are not settled.
Okay.
See, once the market share settles, that would be a time, or when you see at least one of these three sort of throwing down their weapons and saying, fine, we are done, we are happy being where we are. I think that will be the point at which the constructive phase of the industry starts off. Right now, we're just seeing average revenue per user fall. There is going to be a lot of competitive jostling, and you don't want to be there as an investor.
Okay. From a markets point of view, I know markets are at a new time high. Valuations doesn't look that cheap at all. Earnings are going to be still iffy, so to speak. In that context, are we going to see more highs or more rally to this rally in the near term at least?
Whether we go meaningfully higher from here, I think it's hard to say at this stage. What we are seeing is spectacularly high flows, strong flows, both global and domestic. What we are seeing, and is something we've been flagging for a while, that financial savings as a percentage of GDP is going up. What we are also seeing, and we saw the data last week, that loan growth is at a 63-year low. At this level, it was at this level in 1954. So what that means is that the demand for capital is not there. Okay. The supply of capital is too strong, and therefore the cost of capital has to come down. Okay. What that means in the equity markets is that valuations go high. Right? So we are seeing all kinds of IPOs getting oversubscribed and opening 25-30% higher. Now, but this is fairly speculative. So as an investor, if I look 12 months out, I think this is right now not a very strong economy.
I guess you're of the camp which believes that there probably could be a downside risk to the earnings and not the upside risk. So what are you penciling in terms of FY 18-19?
So consensus is till last week was at 18% growth for FY 18. We are at 16. Our bottom up was at 16. But as a strategist,
is that downside risk? 16%.
It is. So as a strategist, I'm allowed to talk about top-down numbers. I think we should be at single digits, maybe mid-single digits.
You are, as a house, constructive on the IT stocks for this year. But given that a sharp, move on the rupee in the last 2 weeks, 3 weeks, and the fact that there is still a bit of a hurdle in terms of the US policies, what it makes for the IT space, and within that, probably will you bet on the large caps, or you think there are a lot of opportunities in the mid-cap IT stocks to bet on?
So let's discuss the rupee first. I think the rupee, there are lots of arguments to say that the rupee should strengthen. But I think what matters eventually is what the RBI thinks about it. Because a lot of these factors we have known for the last 2-3 years.
Okay.
And the RBI has sort of refused to let the rupee strengthen. Of course, their objective generally is to keep volatility low. Okay. But I do think that they try to see when the rupee is over-strengthening as well. And I suspect that on a trade weighted basis, because when you look at the revenue growth for Indian IT companies, you also look at it on a constant currency basis. So the DXY is weakening, the trade-weighted dollar is weakening, is mostly because the euro has started to strengthen. And that by itself will be, there's a fair bit of revenue that the Indian companies get from there as well. So I think what matters is the rupee against a basket of currencies rather than just against the US dollar, just the USD INR. And so I think it will be less of an overhang. I would say that given the derating that the smaller IT companies have gone through, in terms of absolute upside, I think that is where the upside for investors could be better.
Than small cap IT companies. Okay. The other big sector, which has really underperformed of late has been the pharma. Again, some bit of headwinds in terms of currencies, in terms of the policies in the US. Is there a good bet, or there are still real challenges for the IT sector in terms of USFD issues?
So, for the pharma sector, it has gone through a cycle of euphoria, wherein people were giving very aggressive multiples on headline EPS. I think that froth is gone. So the correction we have seen in the last 2 years, I think that froth is gone. Perhaps there was a sense of the sector being oversold, and we bounced back from that.
Okay.
But unlike Indian IT, which is actually a global cyclical, so if there's a global cyclical revival, the sector starts to see that. Pharma is not a cyclical. I mean, there's nothing to do with a global cyclical revival. It's about filings, it's about approvals, it's about FDA. And I think that the change in the FDA, wherein the number of ANDA approvals that they're giving every year has now upped, is now jumping at 30-40% a year, means that there is a lot more of supply. And so remember that it's an unbranded generic market. The customer consolidation process is continuing. It has been disrupted a bit because of anti-competitive claims, but I think the customer base is very consolidated. You have a surge in supply, and therefore it's going to be very problematic for the companies to even maintain their revenues. And all this investigation that is starting to happen on collusion to maintain high prices or to take price hikes is something that is going to force more scrutiny on some of these companies as well, which is another overhang we're worried about. So as a sector, we would say more neutralish than be overweight.
Okay. So I know you're overweight on metals, you're overweight on tech, neutral on, or maybe underweight on telecom, you're slightly underweight or neutral on pharma. Any other sector which stands out, which probably is going to be the sector of 2017? You spoke about IT briefly, but beyond IT?
IT is a big sector. I think energy could be another reasonable sized sector, not purely on the basis of oil price,
sure,
but the fact that if there is a global cyclical revival, then refining margins could pick up. There have been a bit of a sell-off in the government-owned companies because of the disinvestment theme, etc. And I think once that is done, you will see more strength. We also we would also want to be in companies that benefit from a low cost of capital, and I think there could be opportunities in some of those.
High leverage balance sheet companies.
Yes, because I think their costs could actually fall much faster than what the market anticipates.
Okay.